Okay, so your economics, it's not going to be, it's going to be theoretical. You won't have much problems in your economics part, right? But your very first chapter here is national income. So I'm just going to tell you what exactly is national income, how it is calculated, what is GDP, what is GNP, per capita income, and many other concepts which we normally hear in the news channels, right? So every time when you see your yearly budget, which is actually spoken about in the parliament, the constant words which are used is your national income, per capita income, GDP, and GDP is something which they measure a country's economy, right? This is the measure of a country's economy. So why GDP is more important is because how your how our country or the economy of the country is progressing, right? For that, GDP is a measure which most of the economists, or whenever you see a budget telecasted in news channels, these are the words which you hear quite often. Even before we go into the actual theory concepts which is given in your book, let me just tell you what exactly it's a fair idea of GDP, right? So let's say the goods and services produced in our country. When I say goods and services, those are all finished goods and services. What are all the finished goods and services? Very, very simple example, right? You go to a baker. You go to a baker and you want to buy a birthday cake. So the finished product of the bakery is the cake. Okay. So forget whatever is written on the screen at the moment, right? So let me just give you a very small example. Just remember to understand the concepts, right? So you want to buy a birthday cake, and what the baker does, he gives you a cake. Cake is what? A finished product. Okay. So what does a baker use to make that finished product? Normally what are the ingredients which they use in a cake? They will use a flour or they will use eggs, right? So these goods, right? Egg as a separately you can call it as a good as a finished product, right? But these are the products like the flour, maida flour, or the eggs, or the ingredients which the baker used to make a cake. Now I said that the cake is a finished product. What are these products now? The eggs or the flour, the maida which the baker is making. These are called intermediate goods. Okay, having said that, now what actually happens is in few manufacturing services, they will use already finished products as raw materials to make another product. Okay, all these already finished products which are used as raw material to make, say, product. I have made 100 units of product A. I am using the 100 units of finished product A as a raw material to make a product B. This product A is called a capital goods. Capital goods are the finished goods and services which are produced and used as a raw material to produce another product. So what are the three concepts which you learned here? What is finished goods and services? What is intermediate goods? And what is capital goods? Clear with the concept? Capital goods, intermediate goods, finished goods. Because I'm going to use all these words quite often when I go through this chapter. Okay, cool. So having said that, let us start with what is national income? National income is the sum total of factor incomes earned by normal residents of a country in the form of rent, wages, interest, and profit in an accounting year. Pretty simple, right? What is national income? It is nothing but the sum total of factor incomes earned by the residents of a country, the people of the country. It could be in the form of rent, wages, interest, profit in a particular accounting year. One is it is related to rent, wages, interest, and profit. And when is it earned? In the particular accounting year. Okay. So there are like 4 factors of production. Okay. Land, labor, capital, and entrepreneurship. Land, labor, capital, and entrepreneurship. So this is one more concept which you need to understand even before I jump to the concept GDP. Land, labor, capital, and entrepreneurship. Land. Why land? When I want to manufacture a product, right, I need a place, right, a building or a land where I can manufacture the product. So it is one of the important factor of production. Yes. Then labor. Why labor is important factor of production? With just land, right, land or the resources which you have, the raw materials you have, can it directly become a finished product? No. Either you need to do some work or you need to employ laborers to convert the raw materials into finished product. So I'm done with land, I'm also done with labor. Labor is nothing but it is one of the important factors of production. Third thing which I told you is capital. Why capital is important for manufacturing process? Capital, without investment, no business exists. Where will you buy raw materials from? How will you pay your laborers? How will you pay rent for the land? How will you pay rent for the building? No, right? So without capital, no manufacturing or production process can exist. Next is entrepreneurship. It's nothing but the kind of human knowledge, technical knowledge, or the skill which an entrepreneur, or I would rather say a businessman, in very simple words, the kind of knowledge, technical skill a businessman puts into the business so that this business will be successful. So always remember land, labor, capital, entrepreneurship. These are the 4 factors of production. If anytime someone asks you what are the 4 factors of production, then land, labor, capital, and entrepreneurship. Okay, you can make a note of it also. Land, labor, capital, entrepreneurship. Okay, and you should also know what is intermediate goods, finished goods, and capital goods. Right. So these are the 7 things which I want you to remember. Right. So even before we jump into these complex, concepts like GDP, GNP, national per capita income, it's good to know all these things. Okay. All right. Let us move on to the next concept, GDP. Okay. So you remember the cake example which I told you, right? So you go to a bakery and you buy a cake, and cake is your finished good, and the intermediate goods which the baker uses to make a cake, those are intermediate goods, right? Okay. So what is GDP? The most important concept of a national income. So whatever concepts I'm talking about, right? GDP, GNP per capita, these are nothing but they are the different concepts of national income. So national income, I've already told you that it's some factor of income earned by the residents of a country by way of salary, wages, rent, interest, and profit in a particular accounting year. So that those incomes are related only to that particular year. It is not related to previous year, or it is not about the next future year also. It is for that particular accounting current year, what is the income earned by the residents. That will contribute to their national income. So we will look into the first concept of national income, which is GDP, gross domestic product. The most important concept of national income is GDP. GDP is the money value of all final goods and services produced within the domestic territory of a country during a year. Right? The word domestic, okay, let me just highlight it. It will be easy for you. Gross domestic product is the money value of all final goods and services. So final goods and services, it includes everything. If you go to a shopping mall, right from the washing machine or the clothes or anything, everything is a final goods, right? So it will take into consideration only the money value of final goods. It will not take into consideration the money value of intermediate or capital goods. The reason I told you that example of capital and intermediate goods is because you need to understand that the GDP will not include the value of your capital and intermediate goods. It will only include the money value of all your final goods and services, right? This is one part of the definition. Next part is produced within the domestic territory of a country. Does it involve foreign income? No, right? Only if it is produced within the domestic territory of a country. Only if it, in case of India, only if it is produced within domestic territory of India during a year. It is not related to past year or future years. It is related to the particular year, right? Algebraic expression under product method is GDP is equal to P into Q. What is Q? Quantity. P is price. Whereas GDP is gross domestic product. P equal to price of goods and services. Q equal to quantity of goods and services. It denotes the summation of all values. What is the algebraic expression of under product method? GDP equal to P into Q. Okay. So different methods are there to derive your GDP concept. So this is based on the product method. Next is expenditure approach. GDP is the sum of consumption, investment, government expenditure, net foreign exports of a country during a year. Okay. Export, you produce something within your domestic territory, that is within the country, and you will export it. I'm not talking about imports here. You export whatever is produced in your country to other countries, right? So GDP is the sum of consumption, whatever goods are consumed, investment, government expenditure, whatever government expenditures are. Government has its own expenditure, right? They have different policies and plans coming up every year. And for example, we have the Swachh Bharat plan. That is one policy which has come into place in India, and government have allocated some of let's say some money to that particular plan. So that is these are all government expenditure. Government similarly there are various other plans. It could be related to agriculture or it could be anything. And then it's net foreign exports of a country during a year. Net foreign export, whatever is exported from our country to other countries. So this is an expenditure approach which is used. So what is the algebraic expression under the expenditure approach? Is GDP equal to C plus I plus G plus X minus M. Right? Consumption, investment, government expenditure, export minus import. Right? That's why it is said net foreign exports. It just doesn't say foreign export, it is net foreign exports. Net foreign exports is nothing but X minus M here. Okay. Right? Then GDP includes the following types of financial final goods and services. They are consumer goods and services. Consumer goods and services which are directly which are under the consumption of the end consumers, right? Those are consumed by the end consumers. Gross private domestic investment in capital goods, right? So it is considering the investment made in capital goods, not exactly the capital goods, but it is considering the investment made in capital goods. Let's say I'm producing product A, whatever investment I'm making in that product A, value of that. Let's say I'm investing 1 lakh rupees to make product A, and the end worth of the product A, which is a capital good, worth 2 lakh. So I'll be considering 1 lakh. I won't consider the value of consumer goods. I will consider only the value of finished goods and services. However, it will also consider the gross private domestic investment in capital goods. It's only the investment component of capital goods. Government expenditure, yes, and exports and imports. The value of exports and import is required to find the net foreign exports of a country during a year. Okay, perfect. Next, GNP, Gross National Product. Gross national product is the total market value of all final goods and services produced annually in a country. Here, plus net factor income from abroad. Thus, GNP is a total measure of flow of goods and services at market value resulting from current production during a year in a country, including net factor income from abroad. The GNP can be expressed as follows. Okay. Here, what is happening is gross national product. It is similar to GDP. It is also including the total market value of all the final goods and services produced annually in a country. But it will also include the income which you are receiving from abroad. Any sort of income which you receive from abroad, right? So it will take the net income, net factor income from the abroad. Okay. So GDP, the difference between GDP and GNP is something, but GNP is equal to GDP plus where from your GNP equal to GDP plus NFI. NFI is net factor income from abroad, right? So you can just say that GNP it also includes GDP plus your net factor income from abroad. So given in the equation, GNP equal to GDP plus NFI. net factor income from abroad, or GNP is equal to C plus I plus D plus X minus M plus NFIA. Or they are just substituting this product method and or the expense method which they use for GDP. So understand that GDP, it includes the value of your total final goods and services, right? And your GNP includes your GDP plus the net factor income from abroad. Clear? Clear with the concept GNP? Perfect. So GNP includes consumer goods and services. When I say consumer goods and services, it is finished goods and services, because only finished goods and services, it will be consumed by the end consumers, right? And gross private domestic investment in capital goods, it will include, even your GDP includes that, so it will include that also, government expenditure, net exports, exports minus import, net factor income from abroad, and okay, this is a different thing. Net factor income from abroad. So this is a basic concept of GNP, right? So next, we will move on to net national product. Net national product is a market value of all final goods and services after allowing for depreciation. So GDP, you know, GNP is GDP plus your net factor income, but NNP, which is net national product, is nothing but again market value of all products and services after allowing what? Depreciation. So you're familiar with the term depreciation, right? You know, you understand what is what depreciation is. NNP is nothing but whatever the value of final goods and services are after allowing depreciation, right? Thus, NNP is equal to GNP minus depreciation, or NNP is equal to GDP plus NFIA minus depreciation, or NNP equal to C plus I plus G plus X minus M, which is what? Export minus imports plus NFIA minus depreciation. So you're able to correlate, I mean, you're able to find out the difference, right? You're able to find out how it started from GDP to NNP. Clear? Clear with the concept? So next comes NI, national income. So, like we already discussed in the start of the chapter, national income is also known as national income at factor cost. National income at factor cost means all incomes earned by resource suppliers for their contribution of land, labor, capital, and organizational ability, which goes into years of production. So the reason I told you about the different factors of production, now you'll be able to see why I told you about the importance of factors of production, because national income is the sum of all income earned by the resource suppliers for the contribution of land, labor, capital, organizational ability, which is nothing but entrepreneurship. So whatever income is earned by the suppliers of these factors of production, right? It goes into the year's net production. That will contribute your net national income. Or in simple words, the sum total of the income earned by the factors of production is your national income. This is the sum of the income received by factors of production in the form of rent, wages, interest, and profit is called national income. So what is the income received by each factors of production? What is the first factor of production which I said? So what is the income of land? Rent, right? What is the income of labor? Wages or salary. What is the income for a capital? The interest earned by the capital. What is the income for a person who's using his organizational or entrepreneurial ability? The profit. So all together, the rent, the wage, the interest and profit makes what? National income. Right? So what is NI? Further, coming to the formula, net national product plus subsidies minus interest and taxes. Subsidies, government provides subsidies. It's just more like a rebate, right? Government provides subsidies to, for example, for small scale manufacturers, government provides some kind of subsidies to, to start their business or to take care of their business needs and everything. So those are the government subsidies I'm talking about. And so right, like I said, yeah, for startups, the governments do give subsidies, right? So it's just the government subsidies they are talking about, right? Or GNP. minus depreciation plus subsidies minus indirect tax. The whole formula, the entire formula, it will be that of the what is that, expense method. So national income is nothing but your consumption plus G minus your government expense plus income plus import minus export plus net factor income from abroad minus depreciation minus indirect taxes plus subsidies. Okay. So this should be indirect taxes. Indirect taxes plus subsidies. Okay. The other way should be what is GDP, what's national income, what is disposable income, which we will go through further, right? So all you need to know is that okay, the GDP is this. So what does GDP include? Just does GDP includes export minus import? What is GNP? What is extra which GNP is considering from GDP, right? It will consider your net factor income from abroad. Then comes national income. It also includes your depreciation factor, your income from factors of production. So that's how you should be able to differentiate. So these are just important concepts. From this chapter, I expect you to know is what are the different concepts of national income. What is national income? Basically, how do you value the economy of a particular country, right? It is valued based on how much goods and services it produces, what income the residents of that particular country is earning, whether the more you export, the more foreign income comes to you, to the country, and the more you import, money is going out of the economy. It is all about the inflow and outflow of money in a particular economy, right? Having said that, let us move on to the next concept. Personal income. Personal income is the sum total of money income received by individuals and households of a country from all possible sources before direct taxes. Right. Personal income is what I'm earning. So that is the income received by me and households of a country from all possible sources before direct taxes. Even before I pay tax every year, right? Whatever money I get, that would be my salary income, or it could be house property income, or it could be from a business, or it could be from other sources like lottery or winning from gambling or any income which a person earns, right? Even before paying tax on that. That is direct tax. That is called a personal income, right? So personal income is equal to national income minus corporate income tax, right? Less undistributed corporate profits. The part of business profit which is not distributed yet. Social security contribution plus transfer payments. Transfer payments, I'll talk about this particular concept in detail later. But for now, just understand what personal income is. And transfer payments, and there are other cross services payments. We'll talk about it later. It's a different concept. I don't want you to get confused at the moment. Just know what is a personal income. So if you are asked what is personal income, just say the income received by any individual or household of a country, even before paying direct taxes, right? What is disposable income? Income left after payment of direct taxes from personal income is called disposable income. Right, fine. So what is disposable income? Let's say I'm earning 1 lakh rupees. I'm paying 30,000 as tax to the government. What is remaining? 60,000. What I will use that 60,000 for? I'll use it for the rent. I will use it for my bills. I'll use it for buying groceries. Basically, whatever I will spend my income for take care of basic needs of my family, or for the consumption, for providing food for my family, right? So that disposable income is nothing but whatever income is left after I pay my direct tax, right? So that is my disposable income. So DI equal to PI minus direct taxes. From consumption approach, it is nothing but consumption expenditure plus is equal to direct tax. Disposable income. Okay. Simple, right? Per capita income. Per capita income of a country is derived by dividing the national income of the country by the total population of a country. Say national income of a country is 2 billion and the total population is 1 billion. So 2 divided by 1. It will give me per capita income. Right? So PCI equal to total national income divided by total national population. Simple. Right? So these are the concepts which are there in your national income. So it's just a part of, I've just completed 50% of the chapter. We will discuss about rest of the concepts in next